Hello friends, let's understand exactly how the capital adequacy ratio is computed. This calculation is also known as CRAR or the capital to risk weighted assets ratio. The bank's capital is broadly classified into Tier 1 capital and Tier 2 capital, and there are specific requirements as to what percentage of Tier 1 capital can be maintained and what percentage of Tier 2 capital can be maintained, making it a total Tier 1 plus Tier 2 capital base of the bank. The bank's risk is calculated based on the bank's exposure. For example, bank offers various kind of products like term loans, working capital, bank guarantees, letters of credit, letters of comfort, and so on and so forth. And there is a certain amount of risk involved in all those assets. An exposure of, let's say, 10 crore need not have the risk weight of 10 crores. For example, if there is a very high quality collateral against that exposure, then the exposure value could be lesser. So all these assets are looked at, and then the credit risk in those assets is calculated, which is the first component of risk in the bank's portfolio. The other component is the operational risk in the bank. The operational risk comes from the human activities, IT systems and processes, and so on and so forth. For example, the risk of fraud in the bank. If a bank employee collides with the borrower, for example, and commits a fraud, gives them a loan which they don't deserve, the bank is likely to suffer. So this operational risk is also calculated, and that amount is also added to the bucket of the overall risk weighted assets of the banks. The third risk is the market risk. The market risk basically stems from the events that are outside the bank's control. One of the most important market risks for the banks is the interest rate risk. The bank has a very large portfolio of investments, typically in the government securities, which are maintained for the purposes of their statutory liquidity ratio. Now, these government securities do keep changing their values in the market. So price of a government security will go down if the interest rate expectation in the market goes up, and vice versa. So that market risk component in the bank's asset is also taken as one of the risk items and added to the credit risk, operational risk components to make it into credit risk plus operational risk into market risk. Let's say all these risks combined total to 1000 crores in a bank. Then as a percentage of that 1000 crores, the banks have to maintain a certain percentage as Tier 1 capital and a certain percentage can be a Tier 2 capital. For example, under Basel III guidelines, the overall capital requirement of the banks is at least 9%, which means if the risk-weighted assets are 1000 crores, the bank must have at least 90 crores of capital, which means share capital, shareholders reserves, etc. Likewise, of that 90 crores, maximum 20 crores can be Tier 2 capital, which means the Tier 1 capital has to be at least 70 crores and overall the capital has to be 90 crores, which is 9% of the 1000 crore risk that in the bank's portfolio. This is how the CRAR or the capital to risk weighted assets ratio is calculated for the banks. This understanding is important whenever we are talking about the capital adequacy ratios of the banks.